Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and try to help you to understand how tax issues relate to you as an individual. So today I'm going to talk a little bit about national insurance and how how national insurance works and how this is applied in terms of liability. Before I do that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to navigate back to this information if you should need to, as well as being able to find other information that we have available on a whole host of different topics, all aimed at helping you to understand how tax applies to you. So back then to national insurance. So specifically, we were asked how a refund of national insurance contributions would be applied. And it is important to understand that national insurance liability is applied in a completely different way to income tax. That is because income tax is worked on a cumulative basis. So therefore, at the end of the tax year, we're going to look at the total of your income from all sources for income tax and to calculate your income tax liability. And certain sources of income will have been taxed at source throughout the year, and that will be taken into account against the total liability. However, national insurance doesn't work like that. National insurance liability is calculated each pay period in isolation, or each period of question in the event of a sole trader, for example. So this means, for example, as an employee, you could earn well above the national insurance threshold in 1 month if you were paid monthly, pay the national insurance liability accordingly, earn nothing for the next 6 months, bringing your average rate of income below the threshold. But it wouldn't alter the fact that in that one pay period you were above the threshold. So it is important, if you have seasonal workers, for example, to look at ways to ensure that the income is reflective of the earnings period. So obviously, if somebody is doing seasonal work, then it may be that they are legitimately earning over the threshold in some months and not in other months. So it wouldn't be averaged out. They would be liable in the months they were over the threshold and not liable in the other months. But of course, when it would be important is if, for example, a new starter, for example, that hadn't used their previous months had worked for you in the previous month, sorry, but maybe sort of missed a cut-off time by paying somebody 2 months worth of salary in 1 month, is going to potentially impact them in national insurance liability. So it's just important to understand that that the calculation, the liability is per pay period, and it is not cumulative. So each pay period is the liability is calculated completely in isolation to any other. So if in any one pay period that the threshold is exceeded, then the liability will be incurred. In the description, I'm going to pop a link so you can see that the different thresholds that apply and the rates of national insurance that will be applicable. But this can cause quite a lot of confusion. So just to, as I say, to clarify that the national insurance is calculated separately and in a completely different way, and this is why it's not included in your personal tax return except for unless you are a sole trader when you're specifically paying your liability for the period, which would be the tax share on your tax return. So as a sole trader, you would be paying class 2 and potentially class 4 national insurance contributions. As an employer, you will be paying class 1. So thank you very much for watching. And if you haven't already, please do subscribe to the channel. Thank you. Goodbye.